As we suspected, the 200-day moving average has been hit on markets. And while we climb the wall of worry, what happens next is going to have a profound impact for us as traders and investors. Are we going to sell off, or will we see an all-time high? Well, a lot of it comes back to the market structure and how things are looking. With island reversals on some of the biggest stocks in the world, AMD and others forming a base after becoming extremely oversold, and margin on the uptick once again, why should we be paying attention to charts like this rather than just tariffs? Well, in today's video, we're going to talk about stocks, commodities, and cryptos and break it all down for you right now. This one's not to be missed. We'll see you in a moment, guys. Well, welcome back, everybody, to The Daily Show. It's great to have you here, and there is a lot to discuss. My name's Tom, and in today's video, we talk about the sea of green, macro, leading indicators, and of course, some of the hottest levels and charts that you need to be watching. But let's get started straight away by talking about this 200-day moving average. Now, if you're not familiar, this is kind of one of the most important moving averages in the markets. If I was to argue, I would say the 20 and the 200 are the number 1 and 2 when it comes to being able to see dynamic support and resistance. But the 200 is also a trend setter. Have a look at this. If you buy the market underneath the daily 200 moving average since the 1960s, you're not doing very well. When you buy it above the 200 daily moving average, you're in a pretty damn good, strong trend. And this is thanks to Subu Trade. You can see here a very cool stat indeed. But actually, I want to go back and talk about something that we've discussed this year. Obviously, we've been concerned about margin, and I have a couple of different ways of reading it. In particular, this is one of my 7 keys to understanding market crashes and, of course, rallies in our advanced course. Links in the description down below if you want to find out more about that. And there are different ways to read it. Obviously, I have a few different ones. But in general, when you look at margin debt, you can see here that we are not at the same peaks that we once were. And traditionally, when you're talking about bubbles, peaks, market pops, usually you will always see a new all-time high on this particular number, coinciding with the end of a giant market cycle. Now, are we at that in 2025? Well, as you can see, we're not quite there yet. And this is just a quick reminder that every major S&P 500 peak has coincided with a margin debt peak. And while this is only one way to read it, it certainly is a bit of a problem. Now let's talk about tariffs for a moment. Of course, the news is absolutely dominated right now by tariff this, tariff that, and all sorts of problems. If we actually go back over the last 100 years, you'll notice that tariffs were once used heavily by the US and, of course, many other countries. And it's expected, at least according to Bank of America, that we could be looking at 10% overall tariffs over this year. But regardless of what that is, we need to think about what is happening right now. Could we be seeing one of the biggest infrastructure build-outs ever recorded in history? Well, of course, as the US and other countries around the world move to retooling and deglobalization, there's a lot of government spend going through. Here's another read of tariffs over time, so you can get a bit of an opinion there from it. And obviously here, the G20 trade barriers by type in 2022 and 23. So you can actually kind of see here where there are many countries with quite a few tariffs on them right now. So even if the US went up a little bit, in some ways, yes, there are other countries that do have strategic tariffs on certain areas. Now, why is this important? Well, of course, we're all counting down to the April 2nd announcement to find out what's going on there. But really, we have to cut through that and say, are we in a relief rally? That is a rally that was long overdue due to overselling and being in, remember, the 5th fastest sell-off of all time. Well, in our weekend video, we discussed the CTA positioning. We already talked about this a few days before. Again, it was building this bull case scenario that's got us back to the 200-day moving average. But we can see here that CTA positioning was actually pretty much bullish across the board. The uptape over the next month is huge, 69.83 billion. And this just shows you that when you hit these oversold parameters, that oftentimes there is a good case for flows coming back in, regardless of what your opinion is on markets. We also saw hedge funds slowing their selling, institutions slowing their selling, and private clients slowing their buying, turning net negative over the last 2 weeks in comparison to what they had been, which is really strong buyers. Now, of course, what are private clients? It's us. It's retail traders. We were super bullish. Everyone was hyped. And of course, markets need to flush us out. How do they do that? They create extreme fear. And that's why we're seeing sentiment reports that are so bad that they literally hit the same levels that we hit during the worst parts of the global financial crisis. Now, that's a polarized market if ever I've seen one. And it opens up some interesting philosophies here. We already know, go back and check 2 videos ago when we talked about structure, that this is a key turning point in markets. Traditionally, around March 23rd, if you take a look at the last 5 years, we've actually hit lows. In fact, let's just read a couple of these lows here. Great financial crisis, March lows. COVID crisis, March lows. SVIB crisis, all bottomed in March. So it's not, unusual to see markets freak out into March and of course see inflows coming through April because of things like CTAs and pension purchases. And then of course buybacks pushing that narrative really, really hard in the back end of April into May. And the reason why is because of course now we've entered into the buyback blackout period. If you're not familiar on that, again, we did it a couple of videos ago. Now let's talk about why this is important. Again, you go back and you look, okay, well, let's look at 21 years. As you can see here, the Stock Traders Almanac has done that, and we are pretty much on the same trajectory. So for now, you could definitely make a case that, okay, well, things could be bullish. If we went back even further, you would actually notice that we have gone to a point where basically since the 1920s, we've generally seen April as a turning point. That is around April 1st. So again, could change, but at this point, you have to go with the stats overall and of course the price action. Now, there are some other things that pointed towards us maybe hitting the lows. Now, this has got to do with, of course, New York Stock Exchange advances, and they were not looking very good just a few weeks ago. We saw a huge decline in, of course, the stocks advancing. And then we saw that huge breadth increase that we've talked about for the last week and a half. Why is that important? Well, it shows that the market made a switch underneath, and often that can bottom markets. It bottomed COVID, it bottomed, of course, October 22, and possibly it's bottomed right now. We have even more reasons to, of course, like things. The death cross, often considered one of the scariest things in markets, is when you've got the 200 and the 50 moving average, obviously on the daily here crossing. When that has happened over the last 21 times, you can see here that if you bought on the S&P 500 on these Russell death crosses, then generally it was pretty good across the board and the returns were actually pretty phenomenal. So you can see here the dates and what tends to happen. Now, why is this all important? Well, because, of course, all of these things sound very scary. When we're in complete and utter fear, everybody absolutely freaks out and they go and buy puts. And as we've seen on the channel, put buying was at extreme highs after being so low for pretty much the last year. And that really characterizes 2025, up, down, and all around with so much noise that it's hard to cut through the middle. Where I always like to look at cutting through the middle, though, is insider buying. That is, are we actually seeing people that know their businesses purchasing up? And that accelerated about 1 week ago. And of course, that just so happened to be around the lows where we saw those dark pool activities. Now, why is this important? 3 months later, generally, it has been bullish, and we've got a couple of reads there, very similar times. We also saw the cash levels go from basically smashing down to almost extremely low cash levels to accelerating back up. Again, a sign of fear, people pulling their money out of the market. And we know that retail traders did this. Did valuations improve? Well, they're still way too expensive, but again, everything is relative. So have we actually seen a significant repricing of valuations? Price to earnings ratio dropped quite considerably this year, and again, allows some upside. Remember, we are not back to the 2021 peaks or even back to the dot-com crisis peaks just yet when you're looking at just price to earnings. When you're looking at price to sales, well, that's a different story. Of course, we hit massive, massive zones. So it's all about the metrics that you are using. The weekly moving average, of course, defines often whether we have hit a temporary low or not. It's very, 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 very likely we do usually see a bounce off this area. And of course, this can sometimes bottom markets. Another important factor that maybe some people don't consider. Does it always do it? No. Of course, sometimes it sheds it, pushes back up to it, and then we end up getting bigger drops. But in traditional bull markets, that is the ones that you don't want with these bigger corrections, these ones that go to kind of like the 20% bear runs, you do want this level to hold. And of course, for now, it has been holding, and this is an important one to continue to look at. As we mentioned, April 1st is often a turning point for markets, and that we saw rare oversold conditions even in the Magnificent Seven. So really, it's across the board selling in the sophisticated market areas. So that is the big tech stocks. They were the ones that got bashed, and any of the hyper growth. It was risk, 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 and then it was suddenly off, liquidating pretty much where retail tends to sit. You would argue that when you first get into trading or investing, do you really buy healthcare stocks? Probably not. You tend to buy the Magnificent Seven. You tend to buy hyper growth. You tend to buy all these exciting technology businesses. What has this sell-off really affected? It has affected risk on assets, which is where we know retail had the largest amounts of margin. So again, it is a fairly aggressive attack on us, the retail traders, when you're thinking about the algorithms and what has happened. And this is why if we do get a recovery here, a lot of people are going to go out and revenge trade. Remember, that means they'll take extra leverage. They'll go hard. I'm sure a few of you feel like that out there in the markets. And of course, this is something that we need to remember in the back of our minds. In my opinion, this sell-off is not the same as the ones that we've seen over the last 2 years. Every other one, okay, we had that banking crisis. I don't forget about that. No one should ever forget. Remember, markets don't go down for no reason. They go down for valid reasons. It's just that oftentimes those valid reasons, the bad things don't come to pass. In essence, we've just seen one of the fastest sell-offs of all time as well. Here, look at this stat. Crazy fast sell-off. 5th fastest of all time, equaled with the Volcker shock and the Asian financial crisis. And again, you keep coming back to these 3-month stats. Generally bullish across the next 3 months. Now, what have we seen money do? Well, money has floated out of the US. It has absolutely been terrified. It's running from the US due to all sorts of things, and it's gone into the DAX. It's gone into the Shanghai Composite and the HSI and things that we've been already talking about before. But is that really looking that good anymore? If you load a chart of the DAX or the HSI, you would notice that they've hit temporary resistances. And at the same time, what has the US done? It has hit temporary supports. So we've hit here these key levels. In particular, we've seen cluster buying down at the lows. And we were first reported on this about a week ago, as you can see there, and you'll notice where the big buys came in. Now, did we just see some big sells? Well, equal size sells did come through right at the close. And this represents a bit of a problem because, of course, if we're seeing sells here at the 200-day moving average, we know it's such an important read for the markets. It often can act as a bit of a resistance. Now, that's not to say that a person that's buying the dip here really needs to care because, yeah, okay, it could go down for a few days. But that was a pretty aggressive rally with, of course, a pretty aggressive gap left in between. So I'm just letting you guys know, yeah, there were a couple of unusual trades coming in near the close on both big S&P funds and 3 times leveraged semiconductor markets. And that suggests that there could be a little bit of temporary weakness here, and you need to be on the lookout for it. It also suggests that we need to think about structure, because if these markets come back a bit, they even make a lower low, go to 5,400 and then rally, that's not the end of the world in terms of market structure. But if we start to fail here, we go down underneath 5,400 moving forward, then we're talking about the recessionary path of market structure. When you're taking a look at the Bitcoin market and Ethereum, both were looking a lot better. Ethereum started to get less outflows, and of course, Bitcoin is now moving to some pretty significant inflows over the last week and a half. When we think about market sectors, it was risk on, guys. XLY, the worst sector performance, suddenly found big buyers. ITB, one of the second worst pretty much performance, find buyers. That's of course home builders. And then we have semiconductors, the third best. So this was a risk on day across the board. Look at these defensives down here, some of the ones that have done best over the year. They were all off. Everyone was risk on. And this is the type of day that gets people excited. It goes, whoa, yeah, the market's back, baby. The market was probably back a little while ago, a few days ago for sure, at that 5,500, 5,550 level. But this is the type of one that can also suck people into making poor decisions. And I'm sure you've had that before. But look at this. I mean, last 5 days, XLY, KRE, XLF, that's financials. That is consumer discretionaries. All improved. It is a good first sign for markets. And this, again, helps to build the thesis that we've been talking about. Although what happens here is going to be important. So let's talk about the S&P 500. That is a big gap up after, of course, going down. Now, why is this important? Gap down, Gap up on the real market. What is it? It's an island reversal coming off the 50 weekly moving average. Now, we have hit the 200, but I did do some anchored VWAP testing with the 20 daily, which you got 20 weekly, which you guys know is an amazing moving average. Remember, the 20 and the 200 are damn solid, guys. And you'll notice the whole way up, we acted as these 20s were key. So, of course, the 20 is going to be very key as we move up as well. The 200 is important. Don't get me wrong. I'm all about the 200. But the 20 could also act. Now, that's sitting at 58.50. So if markets do try to squeeze a little bit more, we might push up to 58.50 before seeing, I would say, a pullback. And we are looking for structure around this point. But the 200 has been reached. And you can see here when you go to futures markets, it's a bit of a different story. A lot of stuff all sitting around. Now, we thought this was going to be a pretty important level for resistance. And I would guess that there's going to be a sell here. Although if the market is allowed to rally through, there's probably at least another 100 points before seeing temporary weakness. Is this a good sign? Yes, it's not undercut this low, which is going to be important. 5,600, a very important structural low now. And of course, we've got the 5,500 level down below here. So still, this is open, this is possible. But if we get something like this, and it does that, guys, and it goes bad and under 5,400, oh, not good. That is the recessionary path, not the path of structure that you want to see on markets. And this will be a very important time. You have to sub to this channel and channels like this because you really do need to know how this market's acting. And you never want to forget why we sold off up here, which is pretty much retail traders going ballistic. And when retail traders go ballistic, the market sells into us. It absolutely fleeces people. It's very important for us to pay attention to that, of course. Now let's have a look at the options market. What a difference a day makes. Look at these calls. And that's what I'm saying. Everyone went bullish. Look at them. Look at them, everybody. I'm sure a few of you guys were salivating all over the place and saying this is absolutely fantastic. Have a look here. It's a big amount of calls, guys. And that is positive gamma once again. So we are now back, if you can believe it, in positive gamma territory as the markets push higher. But it can act as, of course, a call wall. That is a resistance level. So if you're feeling positive, you're feeling good, yeah, sure. This is certainly a great step. But just remember that like the puts, these can act as resistance zones. So this is going to be a little bit tough for the markets to get through. If it does keep pushing higher though, then we go positive gamma, then we start that squeeze that people want to see, which is the V-shaped reversal. And if you were lucky enough to buy the dips in certain stocks, cool. But just remember, abundance mindset, guys. There are so many stocks like Google and others that, yeah, had a decent day, but they haven't even improved in structure enough yet to say, wow, these things are actually turning the ship. So there's so much opportunity out there. Let's talk about another stock that's been absolutely pummeled, which of course is Tesla. Now, this has been a big move, 220 only a few days ago, all of a sudden 280-ish kind of levels. And obviously we go, well, where could it go? Well, I think it's pretty clear that we're back in positive gamma. We're well above a lot of strikes. And of course, it may try to push towards 300. Just before 300 is a very interesting level. I still think this $950 person's mad. But other than that, you can see here that the markets are clearly showing that there is still a little bit of potential room here up until that 300 barrier. The big stock that I think really matters, though, is going to be Nvidia. The poster child of the bull market so far has been struggling for, 7 months, maybe even 8 months now. And it's still trading around that most traded level, the 115 to 120 zone. And really, we need to get past 125. I've said this so many times, 125, 125, 125. That should solidify that the bulls are back in semis and, of course, potentially push this market back up. So all of these things matter. But lead indicators also matter. We already noted that, of course, the bonds market was showing a temp low, if not the low was in, only, a week ago now. That has still maintained, so that's good. The bonds are not freaking out at this stage. We know that home builders, while looking crappy on charts, improved, not enough to really write home about. And, of course, US yields did rise, but still didn't break either way. So we'll find out more about that soon. As you guys know, I am a big fan of the American consumer, which is this particular indicator. I do have a different way of reading this. Like usual, I put it in, one of our courses. I did a lot of work on it. So, of course, this is one of my 7 reads as well, although I use a slightly different combo on it. And you can see here that it's come off the base. It absolutely got smashed this year, and it's rallied back up. Now, why is that important? Well, because it shows you that the market is trying to do a DCB. That is, it's trying to find a bit of a relief rally after relentless selling. It's perfectly normal. It's still early to call whether, of course, the market has actually done a turn. And that's why we're at that very important fledgling stage. As we knew, 200-day moving average is super likely on the S&P to be hit. But now that it's done it without swinging a new low, there are, of course, positives and cons. And one of the positives has got to be the Magnificent Seven. That is a very nice island reversal tweezer move. And of course, AMD as well, which has found some pretty significant bases. You'll also notice here that the US dollar seems to be trying to find some temp strength. Although I do think there'll be strength, ultimately there's probably going to be weakness. And that's, of course, stopping some of the things that became so popular. As we put a warning out recently, I think gold is in sideways consolidation phase. I think silver, while being incredibly interesting, failed to close high at 33.25 and needs to do that at least from the day trading side of things. Am I worried about silver on a 6-month, 12-month basis? No, I think it still looks really good. But of course, when you're talking about price action, you do want to see a continuous level of higher highs and higher lows. And silver is on the daily 20. So it really needs to, get above these levels, close high, start squeezing again. Can't do that very easily if the dollar is strengthening. We also saw the US oil move here be pretty significant again against the trend, against the news, against a lot of things that have been out there. And you'll notice it's looking okay when you look at the daily and the weekly. There's certainly some strength there. But let's talk about these really nice lows here, such as the Magnificent Seven. That's a tweezer, that's an island reversal, and that is pretty strong. That is a good sign that bases could be put in here in the markets. And again, a very solid island reversal. I mean, it doesn't get much better than that from a textbook base. You got volume, you got gap down, you've got gap up after consolidation. It kind of shows that Wall Street meant business when they're talking about buying in those mags. And just as everyone said they were trash and went and bought German DAX, which of course, I'll just show you German DAX here for a moment. It's not to say the German DAX market's over. I just think it looks a bit weaker. A lower high, consolidation after 20%. Yeah, I mean, it makes sense. Of course it does. It's price action, guys. It's a huge move focused by generally a slowing, dull market. I wouldn't short it personally, but, people will sell credit. People will do certain things around this area if they know what they're doing. And of course, it is just, it's slowing down. It's having to chill. It has to do that. Let's have a look at NVIDIA. Not bad. Move structure, again, helped us to show that the market seemed to be recovering. This was Friday, 14th of March, quite a while ago. It actually improved, and it showed us that the rest of the market should have been at least finding some relief. So far, so good on that one. Of course, improving across the board. These other stocks, PLTR, we talked about in our Monday live show. We obviously talked about it a few times over the last week. The Reddits, the PLTRs, all these stocks that got absolutely thrashed. What is this thrashing attack on? It's a thrashing attack on us as retail traders. Look, this huge rally, this huge dump. Is that overpriced? Probably. But the point is that these rallies get people sucked in, especially new investors and traders. You've been there, you guys know what it's like, and you're sitting there and you're talking to your friends, oh man, the good times keep rolling. And just as you say, I could be a trader. I could be the greatest trader. It just absolutely strikes you. I know what that feeling's like. I traded in 2007-8. I remember it very well, but I'm sure you guys have all had that experience. Let us know in the comments down below. Maybe I'll shout out a couple if you've got some good stories. But yeah, PLTR, a few of you obviously saw this basing structure. Very, very nice. And we've seen that across so many stocks. So if you have a look at like the Teslas of the world, again, it's a polarized stock right now, but the reality was 220 is a put wall, 250 is a call wall. We broke the call wall yesterday. Positive gamma took over. Hedges went crazy. And you guys can see it, 11.93%. It doesn't matter what you think is going to happen to this stock. You might think this stock is dead as a doornail. It could be. I don't know. We'll find out. But the point is that markets, of course, absolutely drop too quickly. They find relief rallies, and even if they end up doing this is perfectly normal. And that's the issue sometimes. You look at it and you go, we're so back, baby, but is it really back? we'll have to look at these 300 levels moving forward. The other one we've got to talk about is AMD. I really like the structure on this. I talked about it. A lot of you in the comment section said, "Oh, Tom, you're mad. AMD sucks, man." And I said, "No, I think it's pretty good." And we talked about this actually in our private community about probably a week and a half ago. There was actually good signs down here that things were improving, coming off a good level. And you can see it's a very significant gain. It's well over 15% in only a week. I mean, yeah, that's not usual. But the point is that it does happen, and there is a lot of different opportunities. There are a lot of opportunities out there, guys. So a lot of different things showing up here on the markets and more to come if we do continue to see recovery. HSI, obviously, I think it's at resistance. That's okay if you're a longer term holder, but if you're a day trader, I'd just be chilling for now, or more on the weakness, I think. But I wouldn't weaken off against a stimmy country that's trying to push the bullishness of their markets with the central bankers. And of course, US 2000, as you can see here, we've got a good recovery starting to come through. So again, weekly looks a bit better, coming off these previous support bases. Good weekly close, should we get it? It will be around the weekly close, I think, this week. And obviously a temp low here being put in by NASDAQ. Very important we hold 19.5. And of course, we've come back, but we're at a temporary resistance at this point. So let's see if we can find strength up here, go back to that previous first support, which you'll notice at 20,700. We get back there, we'll be equaling that off with that anchored VWAP coming off the top with the weekly 20 moving average on the S&P. This would be the next target for the bulls, and the bears would be just trying to push this level low. Because if they push this level low, good chance we get a new low, and then we're looking for that as bulls. So for now, the things do look better, but don't fret either way. Bitcoin, of course, improved. Nothing much changed on structure there. We talked about 84.5 until we get through 92 plus. Not really seeing too many changes. And Ethereum obviously improved 2,065. So obviously an improvement here in terms of a series of higher highs, higher lows on small time frames. Nothing much for a swing trader to walk home about. Solana was similar. XRP obviously finding some strength as well. Now, for the week ahead, what is really mattering? Well, it's really just price action. GDP, them bots can figure that out pretty quickly and they know what's up, so don't worry about that one. And then the core PCE on Friday, that's definitely a piece of news the Fed pays attention to. But really, this is about price action. This is about flows, and we are entering into a big critical moment. What happens here over the next couple of weeks is going to probably determine potentially if we're on the recessionary path or whether we're on the bullish recovery. So guys, if you enjoyed today's video, please remember to subscribe, smash that like button, follow us over on X as well, follow me on LinkedIn for more psychological tips that we're talking about this year in terms of trading and investing. And of course, if you want to find out more about my keys, how I've actually been able to pick things like gold and of course China and other recoveries over the last couple of years, then you can check out our advanced course. I highly recommend it. It's very, very good. And it's great to be here. Thank you so much for getting us 200K recently. We're already at 201. And that's thanks to each and every one of you that make a difference by liking, commenting, and doing everything else. You have a fantastic day. Stay safe out there. Remember, if it's in the press, it's in the price. And of course, patience, react, don't predict. You don't necessarily need to just, go crazy. You just need to always have the temperament to make the right decisions. When you feel biased one way, fear or greed, you're probably going to make a poor decision. Bye for now, guys. Catch up.